Safari. Fantastic, ladies and gentlemen. Welcome back to the Actuary Convention 2020. And I want to appreciate also the panel, Humphrey and the other panelists that were here. We totally appreciate each and every one of you, and thank you for staying engaged with us. And also Ruth Nderito, what talent. That is an amazing, talented, lovely lady. And we totally appreciate that. Hopefully that I'll also find that talent in singing one day. And then I can come for the next convention and sing you a song. But probably maybe I will sing you a song as we proceed. But thank you so much. Now we want to go into a very nice and engaging panel discussion where we are going to go through a journey. All right, and the topic is Safari. We have an amazing, amazing panel that has been lined up for you, but also our moderator who is going to guide us through this particular discussion. He is an associate actuary at the IRA. This is none other than Elias Omondi, a man that you know, a man that you have heard, and a man that we definitely all respect. So sit back and relax your cup of coffee, all right? And make sure that you're going to come into this particular discussion, and there is so much that we're going to learn from it, all right? And also, there's something that has been set up. Because we're having a few challenges, but also we want to give you an email address so that if you have any query and any concern, you can be able to send it to us. This is events@actuarieskenya.or.ke. All right, and make sure that you keep us engaged also in the chat rooms, and we'd like to hear from you. Thank you once again, lovely delegates. Thank you for being here. Let's make sure that we enjoy this particular discussion, because this is our convention. We are the actuaries. We are the ones who are here to turn this world around. So thank you so much, and over to you, Elias, as you take us to the next level. Welcome, and stay engaged. Thank you.
CIC Insurance, we keep our...
Welcome, ladies and gentlemen. I'm Elias Omondi, the chair of the TAS Convention 2020, but also I do work for the Insurance Regulatory Authority as the actuary. We are going to have a very interesting discussion, but before we do that, I just want to give you a sneak preview why we are having this particular discussion. In February 2018, in a workshop organized by the IMF, the governor of the Reserve Bank of Malawi challenged the regional regulators to benchmark the insurance processes to international standards. And this enabled us to develop a collaborative team into adapting the international standards to be tailored within the East African context. As a result, the regional participants developed a team that worked towards developing a framework. And today, I want to introduce to you the Simplified Solvency tool. Before I do that, I want to just take you through the pillars of this particular framework. The team has engaged, the regulators have worked, and we have a quite impressive development. Over the last couple of years, and this is over the last 18 months, we finally developed a simplified Solvency II framework. This particular framework is called the Safari. All of you know what Safari entails. Safari entails a journey. It has taken the team a journey to develop this particular framework. The reason why I stand here today is that I've been the chair of the technical working group which was formed by all the regional regulators in East Africa with the support of the International Development Fund. I've also been working with the IMF as a short-term consultant, ideally developing this particular framework. This framework has 3 pillars, and I just want us to go through the 3 pillars at which we've been working on. The first pillar is basically the risk-based capital pillar. This particular pillar will entail what are the capital requirements. I know most of us are aware that the risk-based capital pillar has some important risks that will be used to define what capital elements that a company needs to have. We have an important aspect whereby also we look at the own funds that a company has. We are also looking at the technical requirements. And over and above that, what are the requirements that you need to use while developing the internal models. The second pillar entails own risk and solvency assessment. It's very important for companies to assess their risks. They need also to assess the solvencies or the solvency amount that they need to have. Over and above that, so many regulators within the region have been using the caramels. Caramels basically entails an assessment that looks at capital adequacy, asset quality, issues around reinsurance, actuarial, and management soundness. Over and above that, it's important to look at earnings and profitability of an institution. Over and above, what we've been doing is ideally we've been trying to come up with aspects on how then do we enhance Caramel's model. And in that regard, we've come up with what we call Caramel's RBS. We know that Caramels cannot entirely look at the risks that most of institutions face within the insurance industry. Therefore, it will be important to look at other risks that might not have been covered under the Caramels model. And that's why we've come up with Caramel's RBS. Caramel RBS basically entails that we are going to look at reputational risk issues, business and strategic and operational risk issues, and above that, the systemic and sensitivity to market risks. We are going to embark on the third pillar, and this particular pillar entails market discipline, issues around disclosure, solvency and financial condition reporting, and above all, the supervisory reporting. We have taken time, we've developed this particular framework, and I'm privileged today to have 2 very important panelists. One represents the insurance industry, and the other one works with the regulator. Let me introduce to you a very accomplished actuaries within their fields. Today with me, I have EDWIN MULENGA. EDWIN MULENGA is an actuary working with the Reserve Bank of Malawi. Remember, this particular concept was initiated in Malawi. I want him to introduce himself, just to tell us what does he do in Malawi, and thereafter I'll go straight to the questions. Before he does that, let me also take an opportunity to introduce Patience. Patience Muvea. Patience Muvea is a group actuary within Kenya. He works with the UAP. Let me start with Edwin. Edwin, can you hear me? Maybe just before he comes in, I want to appreciate the work that was started in Malawi. And today we are happy to say that Africa is finally conquering and developing a safari system. So Edwin, just give us a brief preview of what you do in the Reserve Bank of Malawi.
Thank you, Elias. Greetings to everyone who was tuned in, wherever you are, in these unprecedented times of COVID. I'm glad to be here, to be among the other panelists, and to be with Elias to share with you what we've done. My name is Edwin Mulenga. I'm the Principal Examiner for Pension and Insurance Supervision. Primarily, I've been working with pension funds, but recently I moved to life insurance supervision, and I've worked with Elias and the team from the Eastern Region block to come up with this safari. So it's good to be part of the panelists to talk about what we call is as an exciting achievement for the region and for our insurance market. Thank you, Elias.
Thank you, Edwin. Let me then get to Patience. Patience, maybe you can give us a brief preview of what you do and who is Patience.
Hello, everyone. My name is Patience, as Elias said previously introduced. I'm the Group Actuary at TP Old Mutual East Africa. So I look after the actuarial deliverables for the entity, for the various entities in which we operate, for the various jurisdictions in which we operate in.
Thank you, Patience. So I want to get back to Edwin. Edwin, we started this particular process some time back, and I remember when we were in Malawi at a workshop organized in the Reserve Bank of Malawi, the governor of the Central Bank of Malawi, particularly the Reserve Bank of Malawi, challenged the region that we needed to come up with a proportionate but fit-for-purpose framework that ideally resonates with the international standards. And from that, we've been working with over 7 countries within East Africa to develop this simplified solvency tool. I know Malawi has been in the forefront towards implementing simplified solvency tool, which we are terming as the Safari. Maybe, can you tell us what are the challenges and how are you trying to really properly implement these particular 3 pillars?
Thank you, Elias. As I indicated earlier on, it's been an exciting journey and we've learned a lot. I'll try to outline the challenges that we've made, which have turned out to be opportunities, because through the challenges we have come to appreciate what we need to improve our insurance market. The first one that I would mention, I think it resonates with what the governor of Reserve Bank of Malawi mentioned, that initiated the startup for this safari, is to come up with a proportionate model that is fit for purpose to our region. He was referring to the resource constrained region that we are in terms of levels of expertise, in terms of modeling skills, in terms of data quality, in terms of the risk culture that we have. So these are the challenges that we have in our market, at least in Malawi, and I'm very sure that it's similar in other countries within the East Africa. And these are the issues that we have been working on to improve. So luckily enough, with the help with the Elias working with the IMF, we have come to make it simpler for the insurers. For example, in terms of data quality, what is it that they should come up with? For example, in terms of the risk culture, the pillar 3 the pillar 2, as Elias indicated, has some what we call the OSA, or in terms of Safari, we can call it the CASA, the capital adequacy and safe risk assessment. And this the guideline will help the insurance to improve the risk culture. Personally, I consider that once we work on the corporate governance and risk culture in our institutions, and everybody appreciates that any decision has to depend on risk, has to be risk focused, then it will be easy to adopt this, and it will be easy to come up with the systems, and it will be easy to design a system that reacts to demographic changes, a system that uses the resources that we have. I'll give you an example. Like in Malawi, we don't have any established actuary in Malawi, so this is a very big challenge to adapt the whole Solvency tool. So by having a simplified Solvency tool and then engaging the insurance to a certain level in terms of risk management, we have come to appreciate that the skills are there in the market. We just have to work on it. So in brief, these are the challenges that I would mention that we have made. The other challenges is to do with the nitty-gritty implementation of the model itself. For example, quantification of interest rate risk. As you know, in Malawi, we don't have long-term risk-free assets that would match some of the life insurance liabilities. So that would mean higher capital requirement in terms of the interest risk. Is something that we see under the Safari, that we have to quantify the interest risk. So these are the challenges, that how do we then match between asset and liabilities, at the same time manage the capital requirements that you do. So at the moment, I think these are the challenges that I can mention that we have met.
Thank you, Edwin. And maybe just to also bring members into perspective, we are referring to this framework as Simplified Solvency tool. Now, in African terms, this particular framework, we are calling it the Safari. What does the Safari really stand for? Safari stands for Solvency Assessment for African Reinsurance and Insurers. So we've taken a journey, and finally, we've come up with a framework that is fit for purpose. Let me then fall back to the industry. Now, Patience, I know you've been working within the Kenyan space, and particularly you do represent a company. Kenya has been in the forefront of really implementing the risk-based capital. And when I say that, Kenya took the lead towards developing the Safari. Maybe from your own perspective, what challenges have you or have you basically experienced as an industry when we were really implementing this particular piece of the framework?
Thank you, Elias. I think the challenges around the industry has mostly been around understanding the technical requirements of the risk-based capital model that was being used in Kenya, and then the other challenges for particularly advanced institutions that already had adopted like an internal model, what you call an economic capital. Trying to move from the current economic capital model to what the regulator had proposed, that was also a key challenge. Then just as it may be challenging adopt to any new changes, I think the other aspect was around some of the onerous capital requirements, particularly to do with the prescribed capital ratio of 200%, and the need for companies to strengthen their balance sheets to be able to achieve the prescribed capital ratio, which initially was by June 2020. That was also a significant challenge, because when you look at the Kenyan insurance industry, there's lots of asset holdings that had been in asset classes like property. So there's quite a significant requirement on insurance companies to start realigning the investments, strategies, even their products, and even the way they did their insurance. So there's a lot that was required in terms of being able to be ready and also to start realigning base capital.
Thank you, Patience. Now let me fall back to Edwin. Now, Edwin, we've had a journey, and I can tell you of the last couple of months, we've managed to visit a number of regulators across East Africa. You did mention a couple of challenges, but let me fall back. Out of these particular challenges, maybe there are key benefits that you've managed to pick across the work that we've been doing across the region. What are the benefits that you can attest based on this particular framework? And how then can we ideally push those particular benefits to entirely help the entire African continent?
Thank you, Elias. The major benefit that has come out of this project is what I mentioned earlier. Looking at the challenges that I outlined in terms of level of expertise, in terms of information systems that are there, in terms of demographic changes or lifestyle changes in our region, the challenges that we saw with the Solvency 2 in its entirety and then Simplified Solvency Safari for our region, I realized that these are the opportunities for us to build on, for us to develop, and then to systematically empower the insurers and the market. It's not only the insurers, even us, the regulator, our level of expertise is not at a desired level as we wish. So the benefits that I would mention, I think initially, is that the realization that these are the challenges that we have, and this is how we are going to approach them in order to overcome them. The other benefits that I saw with the safari is this regional integration. You know, as you indicate, as you are talking to patients that Kenya has already been leading, by interacting with Kenya and by interacting with Rwanda and other countries, we learn the experiences, the challenges that these other countries have met and how they overcome them. And then it empowers us to come up with solutions that are proportionate to our country by learning from other countries. The other thing that I would also mention is that the model as it is a simplified solvency too. It means in some aspects, it tries to conform to international standards like European standards. So at the same time, it gives us the opportunity to be competitive at the global level. And if this can continue within the Africa region, if other countries within the sub-Saharan Africa can take it up, it means as a whole, Africa as a whole will be moving forward towards where our colleagues in the Western world or in China or other developed insurance markets are, in order for us to compete at the same level and to be able to supervise internationally. So these are the main benefits that I see. I'll just mention it that particularly in Malawi, the current regime that we have, for example, in general insurance, it just looks at the solvency, just looked at the adjusted net assets of an earned premium over the last 12 months. It's not really that risk sensitive. By bringing in Safari's Simplified Solvency 2, we have come to realize the impact of trying to quantify each of those risks. For example, the underwriting risks, the credit risks, the market risks, the liquidity risks. So it has given us an opportunity to try to attempt to determine how much are these risks affecting our insurance market. So these are some of the benefits that I've seen come from Safari and that the industry appreciates that they'll benefit from this simplified solvency tool.
Right. Very interesting. I want to just pick from where EDWIN has left. Now, ladies and gentlemen, the second pillar of Simplified Solvency 2, basically what we term the Safari, has what we call the own risk and solvency assessment. Now, this particular assessment really requires companies to conduct their own internal assessment to see how they address the risks, to see how those particular risks will affect or will impact their solvency positions. And in this panel, we have Patience, and I want you to take us through the impact of COVID-19 on your RBC. And out of that, how did ideally RBC support you as an institution to really address the risks that were being posed to your entity pursuant to the advent of COVID-19?
Thank you, Elias, again. For my experience and from the companies that I represent, I think COVID-19 has had quite a significant impact on our budget. But what I generally think is that the impact of COVID on a company's balance sheet and eventually on their capital of business is also quite dependent on where the strength of the balance sheet of a company was pre-COVID. What do I mean? That if a company is very well capitalized, I don't think COVID will have a significant impact on the level of solvency that that company had. Of course, there will be reductions in the solvency levels as a result of the market volatility on both the asset side and also the liability side. But for a company that was already thinly capitalized, this COVID-19 situation even makes the situation for those companies. And looking at the risks in terms of how it has helped us prepare beforehand in terms of strengthening our balance sheet, is that if already we had started aligning our balance sheet, our strategies, our product, our investment long before, I don't think the impact of COVID-19 is really going to take away that benefit that had been realized. For me, I think COVID-19 impact is more onerous, mostly from a profitability perspective, mostly from the level of the bonus smoothing accounts that companies do hold, and mostly from the investment income. But if a company was already well capitalized, and if a company had already entered the risk-based capital within the operations and also the strategic models of the business, then COVID-19 is not going to take away that benefit. And I think at the end of the bottom is that the impact of COVID-19 is likely to be more significant on the mortality, on the new business, on the profitability of the company, and also on the investment income. Yes, there has been impacts in terms of the balance sheet, and also in terms of the company's ability to be able to meet the risk capital requirements. But I think also the impact will also greatly depend whether a company is a short-term insurance company or a long-term insurer. So I think in terms of the capital requirements, it's more likely to be onerous on the insurance companies. This is because of the nature of the long-term assets that the companies have, and also the impact of the interest rate movements on the liabilities, particularly on the term insurance companies. So I think in terms of how COVID-19 has impacted the businesses, it's more onerous on the profitability, investment income, and also on the level of the bonus smoothing results or accounts that the businesses hold. So if a company had been utilized since the implementation of risk-based capital, I feel the impact is not going to really take away the benefit that had been realized as a result of the implementation of the risk-based capital in the prior years.
Thank you. Ladies and gentlemen, as we basically come to a close of this, I just want you to know that finally we've come up with a framework that ideally will help us support this particular market. I want to get back to my panelists, and basically I just want them to give me a parting shot. Where do you see Africa, given that we're already coming up with very interesting frameworks that needs to support the African continent? Where do you see Africa going in the next few years? As we close. Edwin?
Okay, yeah, I was waiting. I was wondering who is going to start. Elias, in closing, I think I would thank everybody who was part of this of this discussion. My parting ways in terms of the future of Africa, we cannot run away from globalization. We have to compete at international level. But in order to compete with the little resources that we have, we need to start from somewhere. We need to start from somewhere, but not far away from what the developed insurance markets have developed. That's why we have this safari, and I'm very confident that once we get the grasp of, we grasp the ideologies behind safari, we'll be able to have an insurance market that is quite responsible and that is quite confident for different investors, for different clients, to deal with different insurers all over, for us to be competitive at global level. So what I see in the next few years is that we'll be at par with what other developed countries have been doing, as long as we manage our information systems, we manage our expertise level, and the risk assessment culture. The risk culture in our individual companies. Thank you.
Thank you, Edwin. Patience, your parting shots.
My perspective about how I see the Africa insurance space is optimistic. I think we have many great years ahead of us. And with some of the elements like the risk-based capital supervision in many jurisdictions in Africa, Tanzania, in Rwanda, in Malawi, in South Africa, and in Kenya, this is really going to take Africa global center stage as with international insurers in the sale of insurances. Also, as a result of the past budget, it's really going to make Africa an investment hub for national players who want to invest, particularly in the financial market. I also see with the increased globalization and also the regulatory supervision, it's going to give confidence even to the policyholders. And as a result of this, you're going to see increase in the uptake of insurance products because of the confidence that we give to consumers, that we'll be able to meet the customer promise. So my perspective and my view of Africa is very optimistic, and it's also quite changing as a result of what the regulators putting in place, and also in terms of also how the industry also just regulating itself.
Right. Thank you very much, panelists. It's always a pleasure to have quite interesting views all the way from Malawi. I appreciate Actuary EDWIN, MULENGA, and also our group actuary from Kenya, Patience. Ladies and gentlemen, we've come to an end of this particular session. Mine is to say that for us to create financial confidence, we must have some standards. And Safari basically sets space for us to develop a standard that will create resilience within the sector. Thank you very much, and I ensure that you drop your questions and we will be able to respond to your questions. Thank you very much and enjoy the rest of the discussions. Thank you.